Welcome to the Deep Dive, where we cut through the noise to bring you the essential insights from the world's most important reports and calls.
That's right.
Today, we're taking a deep dive into the second quarter 2025 earnings call for Home BancShares Incorporated. Our mission, as always, is to walk you through the key financials, get a handle on management's strategic vision, and really unpack what it all means for the company's future and the broader financial landscape.
Absolutely. And, these Q2 results, they're not just numbers on a page. They give you a really, I think, compelling look at a company that's growing, yes, but doing it with remarkable consistency and a very clear discipline, which is, pretty vital today.
It really is. So let's kick things off with the big picture, maybe the results snapshot. Home BancShares reported a strong second quarter. Management even said it was a little better than Q1.
Yeah, modest but positive.
And we saw record non-GAAP earnings hit $118.4 million. Now, maybe just quickly for listeners, what exactly does non-GAAP mean here, and why do we focus on that number?
Good question. So non-GAAP, it basically means their profit figure leaves out certain one-time or non-recurring items, things that aren't part of the day-to-day business.
Right.
Think of it as trying to strip out some of the noise. It gives you a clearer view of their core operational performance, how much money they're actually making from just, banking.
Gotcha.
And that $118.4 million translates to a very solid 60 cents per share. So pretty clear indicator of strong underlying profits.
Okay. And what really struck me about that performance was the consistency. They maintained a highly impressive return on assets, ROA, at 2.08%. Now, 2.08%.
Wow.
Why is that number, and the fact it's so steady, why is that such a big deal for a bank like this?
It's crucial. ROA, it basically measures how efficiently a bank is using all its stuff, its assets, to make money. And look, 2.08% isn't just good, it's frankly exceptional for a bank this size right now.
Really?
Yeah. It points to, superior asset use, really good operational efficiency. And when you see that kind of stability, it was 2.07% the quarter before. So almost identical. It tells you they're not just growing, they're growing profitably, sustainably. And that's a real differentiator in banking today.
That kind of stability, yeah, definitely speaks volumes. And speaking of stability, their capital levels, still incredibly robust. Tier 1 capital ratio, 15.6%. Total risk-based capital, 19.3%. Management called it a fortress balance sheet. Can you sort of put those numbers in perspective? What does 15.6% Tier 1 actually mean for the bank's health?
Right. These are like the bedrock indicators of a bank's strength, its resilience. Tier 1 capital ratio, specifically, that's the core capital thing, high quality stuff, measured against its risk-weighted assets. So the riskier the loan, the more capital you need against it. Okay. And 15.6% is exceptionally strong. It's way, way above what regulators require. It means they have this really robust cushion against, unexpected losses, economic bumps, even if they want to grow aggressively.
So that fortress balance sheet line,
it's not just talk. These numbers absolutely back it up. It tells you this bank is built to withstand shocks and, importantly, has a lot of financial flexibility.
Okay, good stuff. All right, let's dive a bit deeper then into that financial performance. Net interest margin, NIM, reported NIM came in at 4.44%, pretty much in line with the prior quarter, even though they had lower event income, as they call it. What's the story there?
Yeah, and what's fascinating is if you strip out that event income, so look at the core NIM, it was 4.43%. But even more importantly, it showed this really positive trend within the quarter. It actually hit 4.47% in June.
Oh, interesting.
Yeah, so it indicates their main profit engine, right? The difference between loan earnings and deposit costs. It's not just stable, it's actually improving. That little uptick in June, that's a strong signal heading into the second half of the year, regardless of what overall rates might do.
That June trend is definitely something to watch. And speaking of trends, deposits, they saw that slight seasonal dip, about $53 million in April. We know that's often tax payments, right? Pretty standard.
Pretty standard, yeah.
Yeah.
Happens across the industry.
But they recovered strongly in May and June. What does that recovery tell you about their customer base, their sort of deposit gathering?
Well, it really highlights the strength, I think, and the loyalty within their core customer base, especially, across those growing states. They're in Arkansas, Texas, Alabama, Florida.
Right.
In today's world, where banks are fighting tooth and nail for deposits, seeing that kind of bounce back after a typical seasonal outflow, it says a lot about their client relationships and, frankly, how effective their strategy is. It suggests they're bringing in those sticky, reliable deposits. which is, gold for a bank.
Yeah, absolutely. And it's not just the core banking stuff, is it? Beyond loans and deposits, their trust, wealth management, and mortgage divisions, they're showing continuous improvement. Why is that diversification important?
Oh, it's incredibly important. I mean, if you rely only on interest income, you're really vulnerable to rate cycles. Right? So by having these other strong, improving non-interest income streams, trust fees, wealth management fees, mortgage banking income, home bank shares, is building a more diversified, more stable revenue base. That fee income is generally less sensitive to rate swings, and it adds this really valuable layer of profitability. It's about having multiple engines, not just one.
Multiple engines. I like that. Now, let's talk about something that I think really sets them apart, their disciplined capital allocation. Over the last year, they grew tangible common equity by $1.36 per share. That's an 11.25% increase. Impressive. Maybe break down tangible common equity quickly. Why is growing it so significant?
Sure. Tangible common equity, or TCE, it's basically the truest measure of a bank's book value, what the shareholders own after you strip out intangible stuff like goodwill from acquisitions.
Okay.
Growing by over 11% in a year. That's fantastic. It means the company is building real tangible value for its owners on a per-share basis. And they're doing this even while they're returning capital through buybacks and dividends. It's real organic value creation.
And they have been returning capital. We like seeing that. They bought back over 3 million shares in the last year, about $86 million worth, and 2 million of those shares just in the first half of this year alone.
Very active.
Plus $150 million paid out in dividends, including that consistent $0.20 per share quarterly dividend. But management also talked about something called buyback yield. What is that, and how does it fit into their thinking?
Yeah, the buyback yield idea, it's quite sophisticated. It essentially tries to quantify the return shareholders get just from the company reducing the share count. Think of it like a dividend yield, but instead of cash in your pocket, you get a bigger slice of the company's future earnings because there are fewer shares out there.
Oh, okay.
It shows they're really thinking actively about capital management, recognizing that shrinking the denominator, the share count, can boost per share metrics just as effectively as paying out cash.
So it's about optimizing that return. And what's really interesting is they're weighing this against maybe doing a special dividend. They said it's under serious consideration, especially since they have roughly $400 million in cash at the holding company. Now, that's before they pay off $140 million in sub-debt at the end of July.
Right, that's a key point. Even after paying off that junior debt, the sub-debt, they'll still have a very large chunk of cash sitting there.
So what is this whole internal debate, buyback yield versus a potential special dividend? What does that signal to you?
It signals a really intense focus on optimizing shareholder value. I mean, talking about a special dividend on top of regular dividends and buybacks. With that much cash, even after the debt payoff, it suggests they've got more capital than they need right now for operations or immediate growth plans.
Yeah.
And this discussion shows they're rigorously thinking about the most efficient way to get that excess capital back to shareholders instead of just letting it sit idle. It's very proactive, very shareholder friendly.
Okay, let's shift gears slightly. Loan growth and asset quality. They had solid loan growth this quarter, split pretty evenly between their CCFG division and the regular community bank. Can you shed some light on CCFG? Why is its growth notable?
Sure. CCFG is their commercial and corporate finance group. So think specialized lending, often larger, maybe more complex commercial deals. The fact that CCFG closed about $500 million in new commitments just in Q2 alone is impressive. That pushed their year-to-date total over $800 million, and the whole CCFG portfolio is now over $1.88 billion.
Wow.
It shows that even though lending is competitive out there, they're not just relying on the traditional small-town banking stuff. They're really excelling in these higher-value commercial segments, too.
Yeah.
Which usually come with, good yields and strong relationships.
Okay. So despite the competition, the pipeline's strong. Management highlighted some big projects coming through. That's positive. On the asset quality side, metrics were, quote, mixed but not materially changed. But they are making progress on recoveries from previous charge-offs, right? $2 million recovered this quarter.
Yeah, towards an expected $30 million total recovery. So they're chipping away at that.
And there was that interesting little story about a non-accrual loan tied to a $9 million yacht. What was that about, and what does it tell us?
Yeah, the yacht loan. It's an interesting detail, but it actually says something important about how they manage collateral and recoveries. So non-accrual means the borrower stopped paying and the bank stopped counting interest income.
Oh, okay.
The key takeaway is that this $9 million loan is apparently nearing resolution with no loss expected for the bank. That's a testament to having good collateral, the yacht, presumably, and being able to work through a tricky situation without taking a financial hit. It's kind of a small anecdote, but it reinforces that message of conservative risk management.
That is reassuring. Okay, looking at operational efficiency and the outlook. Reported expenses were up this quarter because of a one-time lawsuit settlement, $3.5 million. But interestingly, that was almost perfectly offset by $3.5 million in pre-tax income from selling a fintech operation. So basically a wash on those specific items for the quarter.
Exactly, a wash. Which means the underlying core expenses are actually expected to settle back into that $111, $112 million range next quarter. That signals pretty stable operations underneath.
Good.
And what's also really notable, a potential tailwind here, is that the company has almost $800 million in fixed-rate loans maturing in the second half of this year. And the average yield on those loans is only 5.46%.
So an opportunity there.
A huge opportunity. As those loans mature, they can potentially reprice them at today's higher interest rates. Imagine resetting $800 million worth of loans at maybe, 7 or 8% instead of 5.5. Yeah. It's a powerful lever for future earnings.
Definitely something to watch in the back half. Okay, let's zoom out a bit now. Investor context. Starting with strategic growth, M&A. Management set some pretty ambitious income targets. $450 million for 2025, $500 million for 2026. And they explicitly said these targets basically require acquiring more assets. What does that tell you?
It tells you M&A isn't just an option. It's a core part of their strategy to hit those big numbers. They're not just relying on organic growth alone. And they're actively pursuing several whole bank deals, mostly in the $2 to $6 billion asset range.
And geographically.
Focuses within or very close to their current 5-state footprint. And they sounded pretty keen to announce something before the next quarterly call. So yeah, they're actively in the hunt.
Now, what I found really fascinating here, and they really hammered this home, was their firm stance against dilutive deals. They kept emphasizing accretive acquisitions, and they directly contrasted their approach with other serial acquirers whose stock, they implied, has gone nowhere because of bad deals. Can you quickly break down accretive versus dilutive? Why is that distinction so critical?
Yeah, this is maybe the most defining point of their M&A strategy. Accretive means the deal immediately adds to the buyer's earnings per share. So you buy something, and right away your profitability per share goes up.
Makes sense.
Dilutive is the opposite. The deal reduces your earnings per share, usually because you paid way too much or issued too much stock, or the target just isn't that profitable.
Right.
Home BancShares' commitment to only do accretive deals means they're putting shareholder value and long-term earnings growth first. It's not about just getting bigger for the sake of getting bigger. And yeah, that discipline, that direct contrast they drew with others, that's a huge differentiator. And probably explains why their balance sheet is so strong. They haven't destroyed value through bad M&A.
Absolutely. That clarity is key. Okay, how do they navigate the interest rate environment then? The company is still asset sensitive. What does that mean if, say, the Fed does start cutting rates?
Right, asset sensitive. It just means their assets, primarily loans, reprice or react to interest rate changes faster than their liabilities, mainly deposits. So if the Fed cuts rates, Home BancShares is actually in a decent spot.
How so?
Well, they can potentially lower what they pay on deposits faster than their loan yields come down. This helps protect their net interest margin, that core profitability measure. It gives them flexibility in a falling rate environment.
Okay. But interestingly, management had a pretty nuanced view on rate cuts. They weren't exactly cheering for them. They said they prefer a slow, premeditated drop, not a rapid slash, to avoid reigniting inflation.
Exactly, which tells you they're thinking strategically, bigger picture, not just about their immediate NIM. A slow, controlled rate reduction is less disruptive for the whole economy, less likely to spark inflation again. And ultimately, a stable economy is better for banks in the long run. It reflects that sort of conservative long-term view they seem to have.
And one last thing, a unique bit about their operating philosophy, their hiring approach. They specifically avoid aggressively poaching whole lending teams from competitors. They prefer to grow talent internally. They called poaching a detrimental practice.
How significant is that stance in banking?
It's actually highly significant and pretty unusual. In banking, especially commercial lending, poaching successful teams, bringing over their loan books is really common. It's a quick way to grow.
Right.
But it often causes, cultural clashes, high turnover. It damages relationships within the industry. Home BancShares' approach, focusing on cultivating talent internally, building from within it, suggests a focus on long-term stability, a stronger internal culture, and maybe more sustainable growth. It's slower, sure, but it probably builds a more cohesive, loyal team over time.
Yeah, it's definitely a different take. And one final point on risk management. While they're comfortable with their current loan loss reserves around 1.86 to 1.89%, management expressed a personal preference for a 2% reserve. What does that little bit of extra conservatism signal? It just highlights, again, that exceptionally conservative, proactive approach. The loan loss reserve is the bank's piggy bank set aside for potential bad loans. Their current level is already strong, probably well above requirements. But management personally wanting 2%, that signals they want an even bigger buffer. It reinforces that fortress balance sheet idea. They're preparing not just for what they expect, but for the unexpected too. It speaks to a really prudent culture.
Okay, now for our quick thought experiment. And remember, everyone, this segment is purely for informational, maybe entertainment purposes. It is absolutely not financial advice. Please always do your own research.
Definitely.
But given everything we've discussed, Home BancShares, really strong capital, their clear focus on accretive M&A, their aversion to dilution. Here's an idea to maybe mull over.
You can think about what's called a quality long position in Home BancShares. The thesis is pretty straightforward, right? Their strong balance sheet, their disciplined capital allocation, remember the buybacks, the potential special dividend consideration, and that laser focus on accretive deals really makes them stand out. They seem to be growing with real intention and financial strength.
And here's the sort of outrageous but plausible twist. You could potentially pair that long position in Home BancShares with a short position, not on the whole market, but on a specific basket of regional bank peers.
Oh, okay. Which ones?
Specifically, you'd target those peers that have a history of doing those value-destructive or highly dilutive M&A deals, the kind that haven't really delivered long-term value for shareholders. The exact type of serial acquirers that Home BancShares management seem to be contrasting themselves with on the call.
So you're basically betting on Home BancShares' discipline and their fortress balance sheet to outperform those peers who might be tempted into less disciplined growth for growth's sake.
Exactly. It's a bet on the disciplined outlier against the potentially less disciplined pack.
It's bold, for sure. But it's definitely grounded in what management themselves laid out as their strategy and their key differentiator.
So, in sum, Home BancShares delivered a very solid second quarter. You see robust financials, really disciplined capital management, and a very clear, very intentional strategy for future growth focused squarely on accretive M&A. Hopefully this deep dive gives you a clear picture of a bank that seems to be building for the long haul.
Yeah, a clear picture indeed.
We hope this deep dive helped you cut through some of that earnings call noise and feel a bit more informed. Now, as you think about Home BancShares' approach, maybe consider this. In an industry that often seems driven by just getting bigger, what really defines long-term success? Is it just scale? Or is it maybe this kind of relentless focus on disciplined, shareholder-friendly growth? Something to chew on.
Good question to ponder.
We'd love to hear your thoughts on this call, too. What stood out to you? Let us know.